Thank you for joining us this morning. I'm Jeff Pintar with Pintar Investment Company, and I'm really excited to have Jim Sullivan of Green Street Advisors join us in our webinar, where we'll be discussing all things real estate and COVID-19 and what the potential future may look like. For those of you that might not know Jim, Jim is Senior Advisor at Green Street Advisors, which is the preeminent research organization for pension funds, companies that are considering doing IPOs, non-traded REITs seeking strategic advice. Jim has 26 years of experience with Green Street, providing guidance and advice to hedge funds, pension funds, private equity firms, family offices, and the like. Jim, in his experience, has been traveling around the world advising investment companies, real estate companies in India, Australia, Europe, North America. He sits on and is a member of NAREIT, ICSC, Pension Real Estate Association, and the Association of Foreign Investors in Real Estate. In addition to that, he's also a member of the board of directors of Bixby Land, which is a private real estate company here in Southern California. And he holds an MBA in finance and real estate from Columbia University and a BA in economics from Duke University. So with that, Jim, thank you very much for joining us today. And I know the audience, as well as myself, are very interested in getting your thoughts and what you and your clients are seeing and talking about during this time. And maybe I'll just jump right into it. In late 2019, I remember being a part of at a real estate conference, and I was in the audience, and you were a panelist, and there was a lot of discussion around the euphoria at that time of people bidding up properties and buying properties at what seemed to be a very aggressive cap rates, and there was really no bottom in sight in terms of how low people would go with cap rates. And as we sit here in May of 2020, I'm just kind of curious your thoughts of that comparison between the look we had coming into 2020 and where we are now.
Thanks, Jeff. And first of all, thanks for inviting me to be here, and good morning or good afternoon to everybody that's on the call. Wow, 2019 in real estate years, that seems like a decade ago, even though it was only a few months ago. And thank you for remembering that panel. So I was on a panel, and a number of the participants on the panel, when asked about the state of the real estate market, where we at, where we headed, 3 in a row used the word discipline. The lenders are being disciplined, and the buyers are being disciplined, and the developers are being disciplined. And I heard that word, and I've been in the real estate business a long time, and I love the commercial real estate industry. And the commercial real estate business is a lot of things, but one thing it is not is discipline. When buyers have capital, they buy. When they have construction loans, they develop. When the auction tents get really crowded with lots of well-capitalized buyers, they bid a higher price, a lower cap rate. That's what our business is. And I equated it on that panel to our business being not disciplined, but more like a fraternity house. And what I meant by that was that, we have a great party, and then the party gets out of control, and then everyone goes home and they wake up Sunday feeling pretty crummy. But by Wednesday, we're all thinking about the party this Friday night, and people get excited, and Friday rolls around and they start showing up, and the party gets going, and people are having a great time. And then around midnight, some of the disciplined participants at the frat house say, you know what, this has been great, I'm out of here. And they go home with great memories of the party. And then some others say, this is so good, I'm going to stick around, and they party into the early morning hours. And then, inevitably at the fraternity party, somebody stands up on the bar at 2 a.m. and shouts, tequila shots for everybody. And some people say, wow, the tequila shots are starting. That means I got to get out of here. And they leave the party with good memories. But then there's a group of people who look at the guy in the bar and they say, you know what, tequila shots, that's a good idea. I'll take 2, please. And then at 3 in the morning, somebody falls down and gets hurt. At 4 in the morning, the fist fight breaks out. And at 5 in the morning, that's when the cops show up and clean it all. That's our industry. That's the commercial real estate industry. And I was opining in 2019 that it felt like it was probably 1 a.m. You know, some of the disciplined party goers had left. Others were doubling down. The excesses weren't too bad, but you kind of felt like they were coming. And Jeff, earlier this year, I was on a panel and I made the comment that the lack of concern in commercial real estate was a cause for concern. People have become very complacent. Occupancies are high, rents are growing at 1 and 2 times, 3 times inflation. Everybody's making money except for mall owners. No matter what kind of commercial real estate you're in, things were great. And, you know, we've learned over the last 2 months how quickly things can change. So, you know, the absence of concern was a concern. And we never know what's going to upset the apple cart in commercial real estate. But the last 2 months have been quite interesting.
Yeah, I love that analogy of the fraternity party, you know, maybe because I still have fond memories of the ones I attended. I don't know. But it's interesting. So maybe we got to about 1 a.m. Where there was some, you know, lack of discipline being shown. And now here we are, definitely in some kind of a hangover, but the hangover we're living through right now isn't attributed to, you know, the lack of discipline that, or at least we haven't seen it from the lack of discipline that maybe it was taken in the last maybe year or two, because, you know, values ran up and all the things that you're describing. But the cause of where we are now is something that nobody, I think, would have ever underwritten or anticipated, but it's clearly had an impact and is causing significant pain and stress. And you shared with me a slide that I'd like to kind of bring up right now, which talks about, you know, some of the valuations of the different real estate asset classes and what they've done and how they've, you know, been impacted due to this, you know, COVID-19 situation. And maybe you can just walk us through this a little bit, where you're seeing, you know, obviously the malls on the very, you know, low end, most impacted of valuations. And, you know, maybe walk us through the slide a little bit.
Yeah, so thank you for putting this up. And you know, for those that don't know, at Green Street Advisors, the firm I work at, we're very well known for our analysis of publicly traded real estate companies called real estate investment trusts. And in Newport Beach, we have 40 analysts that cover about 80 companies here in the US. We have a team of 15 professionals in London that cover 45 or so publicly listed real estate companies in the UK and across Europe. And what this chart shows is the change in share prices and the change in implied real estate value for the 80 or so companies that we cover here in the US. And one of the really interesting things about the REIT industry is that REITs are highly specialized. They specialize by property type. So you have, across the bottom of the screen, you have REITs that own data centers, single family rental portfolios, office, and so on. And what the chart shows is what's happened to values since the peak of the market on February the 21st. February 21st, the REIT index, the Dow Jones equivalent of the REIT industry, peaked. And then it's been a challenging environment since then. The light green bars show changes in share price. So the light green shows that we've had a range from 0 in share price for data centers to you know, minus 60 in the mall space. The dark green bars are the impact on, is what the public market says real estate values have fallen by on an unlevered basis. So the difference between the green bars and the light green bars and the dark green bars is the light green bars are share prices, which include the leverage on the balance sheet. And the dark green bars, I think, are more telling because it's what the public market is saying real estate values and prices have fallen by since February 21st. And what's interesting is you see really quite a wide range. And on the left side of the screen, you see data centers. And those are companies that own these giant warehouses that are just filled with computers and computer servers. And if you think about work from home, if you think about e-commerce, all of that activity, this Zoom call is running through a data center somewhere. And if you can point to any property type that's been a beneficiary of what's happened over the last 2 months, it's data centers. Towers, those are cell tower companies. The three biggest REITs by equity market cap happen to own cell towers. And you think about data activity and communication that's happening through cell devices, towers have fared pretty well. If you go to the other extreme, if you go to the right-hand side of the exhibit, you see the property types that have really been hit the hardest. And malls have been particularly hard hit. Malls were struggling before February 21st. The acceleration in bankruptcies for retailers, including department stores, has been really bad for the mall industry. And what's happened in the last 2 months is simply an acceleration of what had been already happening. Healthcare, if you've read the papers, you know that a lot of the deaths associated with coronavirus have happened in nursing home facilities and assisted living facilities. And the healthcare REITs own a lot of those kinds of properties. So it's not surprising, given the headlines and the reality taking place in these facilities, that healthcare has done poorly. And then lodging, the hotel industry just decimated with the fall off in travel. The hotel REITs have literally closed anywhere from half of their properties to 3/4 of their properties because it's cheaper to have them shut than to operate them at 5, 10, 15% occupancy. And then everything else falls in between. And what I would note here, Jeff, is that this slide, which I think represented closing prices a day or two ago, is very different than what you would have seen, say, on March 23rd, which is when the market hit its bottom. And what happened on March the 23rd is that there was very little differentiation in the green bars. You had a lot of companies that were all bunched together, including single family rental, which was down quite a bit and quite a bit more than is shown on this slide. And what happens in the public market, because these stocks are freely traded and very liquid, is investors reacted to coronavirus by taking everything down. I want to sell everything and then I'll figure it out afterwards. This chart, by contrast, shows that there's been some real selection. Okay, now that I've had a chance to take a deep breath, malls, really bad. Senior living facilities, really bad. Hotels, really bad. But single family rental is an example of where we've seen things come in better than expected. We saw April and May collections of rent better than expected. We've seen one of the big public companies in the SFR space talk about an increase in its occupancy over the last 2 months. So we've seen some, I think, very explainable answers and explainable rationale as to why some of these stock prices have moved the way they have, which wasn't the case in the panic that happened between February 21st and March the 23rd.
Oh, thanks for that. Yeah, I mean, when I look at these values, it's not surprising on some of the asset classes. You know, you talk about malls, and they were under a tremendous amount of pressure before the pandemic hit, and this is probably exasperating, you know, the fallout of, you know, the inferior, you know, tenants, as well as the locations that were just hobbling along. But it makes me wonder, you know, are these values kind of here to stay? Is it a massive reshuffling of the deck of where capital is going to be flowing and be interested in? You know, there's always intrinsic value and market value, and so, you know, the equity markets are telling us what the market value is, and those tend to swing. That pendulum tends to swing. You know, in the bad times too fast in one direction, and then in good times maybe too far in the other. And so I'm curious in your thoughts, is this a period of time, that we're going to look back at as, the pendulum swung too far on some of these asset classes, or is this a reshuffling of values that we're going to see in the future, and capital is going to be flowing into, different asset classes like it hasn't ever before?
Yeah, it's a great question and a really hard one to answer, but I'll give what I think is a framework for at least thinking about an answer. And to step back for a moment, when you're an investor and you invest in a publicly listed real estate company, what you're buying is primarily a portfolio of high quality real estate and attached to a management team that, if they're really good, will take your capital, the money you give them, and for every dollar you give them, turn that into something worth more than $1. So you should be willing to pay fair market value for the real estate, and you should be willing to pay a little bit of a premium to be attached to a really good management team that will create value. And then lastly, in the public market, you should be willing to pay a little bit of a premium for liquidity. And a lot of points in time, liquidity doesn't matter very much, but when it matters a lot. And the reality with a REIT is you can sell it today. You may not like the price that you get. The price may be lower than what you paid, but you can turn your real estate investment into cash money today. You can't do that if you own a shopping center. If you started trying to sell a shopping center today, 4 or 5 months from now, you would turn that asset into cash. So liquidity, you should be willing to pay a premium for that. So it's not surprising that over the last 25 years, the average REIT has traded at a 3% premium to the market value of its assets. So you're paying fair market value attached to a good management team, a little premium, and a little premium for liquidity. So the average REIT is traded at a 3% premium to the market value of the assets. Now, that's a really important statistic when you can confidently say, here's what I think the market value of this apartment portfolio or this office building portfolio in New York City or this 100 property portfolio of hotels. There are many points in time when you can confidently say what market value of real estate is. Today is not one of those times. I can't tell you what the right price is for a mall. I can't tell you what the right price is for a hotel. The public market, per the chart that you put up, is telling you the price today is a lot lower than what it was just a few weeks ago, but is down 30%, even in the ballpark. I don't know. The public market is right more often than it's wrong when it says, here's where I think prices in the private market are headed, but it's not always right. Sometimes there are head fakes, and those head fakes tend to happen in times of uncertainty and distress, and we certainly are in a time of uncertainty and distress right now. So I think there's a strong argument that the public market has overshot the mark, but I'm open-minded that the public market, with portfolio managers betting hundreds of millions of dollars of their money and their clients' money, they're trying to get to the best answer that they can. And while we may have overshot the mark, I think it's important to ask the question, well, what if the public market's right? What does that mean for private real estate values 6 months from now, a year from now? Might we see down 30% in the hotel business? Might we see down 30% in the mall business when things actually start to transact? Buyers and sellers agree on what things are worth. We may have overshot the mark, but we may not have. It's a very difficult question to answer.
It really is a difficult question. And I think, in times like these where there's significant illiquidity in the financial markets, valuing an asset class, which traditionally has been, somewhat easy and consistent because there's comparables and you can forecast what revenues are going to be. I look at the lodging industry, who's impacted not because people aren't willing or to go and stay in a hotel, but literally they haven't been able to. And it's a mandate, obviously, the government's put on the population of you can't do this versus the population saying I won't do this. And so, you think of gaming, leisure, real estate, entertainment real estate, restaurants, movie theaters, casinos, hotels, you know, when the stay-at-home restrictions are lifted and the government's no longer telling the population you can't do this, is the majority of the population going to say, I just won't do it because I don't want to take that risk? Or, you know, will the values in those asset classes come back, you know, close to historical values in occupancy and revenues?
Yeah, I think it's the question. What sort of behavior is being changed temporarily, and what sort of behavior is being changed in a much longer term kind of way? And I think it's very dependent on the property type that you're talking about. So, you know, for example, in hotels, now that business people have been forced over the last 8 weeks to communicate with their clients, to communicate with prospective clients, to communicate with their peers and their teammates via Zoom and Zoom-like programs, you know, that this is interesting. This works better than a lot of guys like me with gray hair might have expected. How anxious am I to jump on a flight to Boston to meet with a client and a group of clients versus doing this instead? I think that's the type of question that we're asking with respect to full service business hotels, with respect to casinos in Las Vegas. I think there's a lot of consensus in a lot of property types that some of these impacts are temporary and some of them are longer term. And I would say the one property type where we internally at Green Street have the greatest debate is office. And in fact, this morning with our research team, we were having that conversation. And I think it's pretty easy for guys who own big houses and are empty nesters to say, hey, this is working great. I don't ever need to go to my office. And then a young guy who's 30 living in a 2-bedroom apartment with 2 little kids running around, he's saying, you know, this is okay, but I got to get back to the office because I need a sanctuary. I need a place where I don't have the distractions. And so a lot of debate around office. I think it's hard to see us cramming more and more employees into less and less space in office. So I think that's a trend that where the pendulum, you spoke about the pendulum before, it had probably already swung too far, and that's going to swing back in a very significant way. We're just going to need more square feet per employee. I think this WeWork concept of shared office space, where every day you go in with your Apple computer and sit next to somebody you don't know at a desk where the day before it was occupied by somebody you don't know. It's hard to see how that survives what's going on. And then geography, you know, I think it's pretty easy for us here in Orange County, California, you know, driving our Porsches and our Audis, or some of us driving fancy pickup trucks to work. You know, it's easy for us to commute, but you know, think about that commuter in New York City who has to take the subway for 30 minutes. Think about mass transit in San Francisco. Think about Chicago, where everyone gets to work via the train and the subway, and the elevated train. I think office is the place where we're going to see the greatest sort of debate. I think New York, I think any city that has these intense commutes is a loser. I think suburban locations, particularly lower cost, lower tax types of places, think Boise, Salt Lake City, Nashville, Raleigh, Durham, those have to be the winners when it comes to office. But if they're winners for office, think about how they need to be winners as well for shopping centers and for your business, the single family rental business. Those are the places where I think people are going to go. I think that's where the jobs are going to be created. I think that's where the jobs are going to be exported to. And some of that was already happening, particularly from California to lower cost settings. But I think what's happened is going to accelerate those trends in a very significant way.
Yeah, and that's interesting. One of the topics a couple of topics I wanted to touch upon and really pick your brain about is, you know, in past downturns, and I think you said that, you know, there's value in being an old guy, and I wouldn't say you're an old guy, just say you got some more gray hair than I do. But in past downturns, there's always been winners and losers of different product types. How do you handicap? So it's kind of two questions. How do you handicap, which asset types will continue to go from strength to strength, to which are going to be, forever changed? And we've touched upon that. And we also talked about, you've mentioned SFR, which is our asset class that, we invest in and have been in the last decade. And, early March, when all the news was starting to come out about shutdowns and things like that, it was almost, this can't happen. I mean, that's never going to happen. What are we talking about? It's crazy talk. To no, it is happening, and it's happening right away. Our sort of optimism with our ability to collect rents was really challenged. But to your point, we and other people's in our space, I think, have been pleasantly surprised in a renewed faith in humanity that people actually are paying their rents. In our own portfolio, our April collections were, 98%. And so on par with, what our underwriting and has been historically. And in May, it's on track with April. And so, that's encouraging. And so, so that leads also to what the point you were kind of talking about is there's been discussion about a flight to the burbs, which, historically has always happened. We've seen communities expand outside of their center. And, we've had a little bit of a retraction of that through the last few years where people were moving closer and closer to the job centers. But it seems and it feels like, based on discussions we've been having with other peers, is the leasing activity in our portfolio and others' portfolio, in SFR particularly, not so much multifamily, especially in the burbs, is remaining strong. And so, a couple of things that I'm loading you up with questions are, winners and losers. What can we learn from past, crisis? And this flight to the burbs, is this going to be a permanent sort of activity or action and move of the population, or is it temporary?
And I think what we're going through has a financial element to it, but it has a behavioral element to it. And let's talk about the two independently. So being a real estate finance guy, when this started, naturally, I and my peers pulled out the playbook from 08-09, which was a financial crisis. We pulled out our playbook from the early 90s, which was a financial crisis primarily for real estate, and tried to draw analogies. Okay, this is what happened last time. This is what happened first. This is what happened second. And then when the recovery happened, here were the winners and losers. Here were the beneficiaries, and here are those who got wiped out. But as we got into this one, our first reaction was this is going to be a financial crisis. This is going to be a recession for sure. How deep and how long, and would seem to be the debate. So who can afford to pay rent? Which building owners can afford to pay their mortgages? Will there be capital for real estate participants? Will it be reasonably priced, and will it be there in abundance or in a shortage? That was the finance side of it. But we quickly began to understand that with what the government did, which was a quicker, swifter, much bigger reaction with very little debate, for those that were around in 08-09, should we do this, should we do that, led to months of debate. And when the numbers got into the hundreds of billions, people started to choke, no less when they got into the trillions. This time around, there was virtually no debate. It was how many trillions are we going to throw at it, and who's going to get the trillions that we're putting out into the marketplace. So it quickly evolved from this is a financial crisis in terms of capital availability and cost for real estate owners to a behavioral crisis. Are people going to pay their rent or not? Are people going to move out of cities to suburbs? Will anyone ever shop at a mall again? Anyone ever rent New York City office space again? So the winners and losers here, still might be defined by the financial attributes. There are a lot of people who are unemployed. There are a lot of businesses that are failing. There are a lot of owners of commercial real estate who are not receiving rent, and in response, they cannot afford to pay their mortgages. So the financial aspects are pretty significant. But when we think about winners and losers, I think those are really going to be defined much more by behavioral changes. And it's really hard to see how the mall business survives in its former state. There are 1,100 malls in the United States. We may cut that number in half. And I think that has profound implications for the communities where those malls that are closing are located. I think we have profound changes in how people interact from a business standpoint, the Zoom call being an example. And I think the implications for data centers is interesting. People are already using e-commerce, but now not only can I get my sweater delivered to my house in 1 day's notice from Amazon, now I can get my groceries at my front door too. That's interesting, and there are implications that are positive for warehouse owners through which all of these goods ultimately get transported, repackaged, and delivered to your house. And it has significant implications for the grocery business. Where do I get my groceries? How do I get them? So I think some of the behavioral changes are significant. I think the behavioral changes will 2, 3, 4, 5 years from now really define who the winners and the losers are. In the shorter period, the next year or so, you'll see some owners of commercial real estate get foreclosed on. You'll see things get repriced, but it's these behavioral changes that I think are really interesting. And with respect to the SFR business, the single family rental business, there seem to be some positives that come out of this, in the sense that, whatever stigma there used to be on renting a house versus owning a house, that had already eroded over the last 10 years or so. And I think that continues to be the case. I think flexibility, where do I want to live? Where's my job going to be? Should I buy, or should I keep some flexibility by renting instead? I think that's interesting. And I think the build to rent trend, where home builders were building communities of houses, which they then sold to folks like Pintar, where these communities were entirely rented as opposed to sold to individual owners. I think that trend is going to accelerate as well. So I think some of the behavioral changes are actually, it's easy for me to see how those are beneficial to the businesses that you're closest to.
Yeah, it's definitely interesting times, and I think you said it at the beginning of the call. 2019 seems like a decade ago, or a lifetime ago, and what's happened in the last 45 days. I hear the word unprecedented a lot, but I think that it's accurate. It's at some levels it's crazy to experience and see what we were going through. But I remember in the last downturn, new industries got created, like the one I'm in. And you can imagine there'll be new industries that are created that come out of this, because there's a lot of smart people out there with great ideas that maybe haven't had the opportunity or been forced to, explore and really formulate it and put it into an execution. And so, I'm a believer in, our country, and I'm a believer in the talent we have. And so, definitely there's going to be asset classes that are forever changed. Some significantly, some, we talked about the office, and you've touched upon it, of, the space and the uses of it. And, will people, will corporations need those large office spaces anymore and jam people in it, or more people are going to work from home, and maybe it's different communities. Let me switch gears a little bit though. And what I might do also is and I failed to mention this earlier to all the participants out there, is if you have a question, this is meant to be interactive. Just on your screen, you should have, if you slide over it, a Q&A button you can click, and then just type in a question, and I'll be happy to read it off and have Jim address it. But so please, if you have questions, send them through, and we'll do our best to address it. But maybe switching gears a little bit, I don't think you can have any discussion about real estate without bringing up interest rates and the topic of interest rates and liquidity. And while the last 45 days, I think the liquidity in the financial markets has been shut off, there's a lot of borrowers out there that are, frothing at their mouths to take advantage of historically low interest rates. And, just curious what your clients are telling you or what you're seeing as it relates to potentially those markets opening back up and some of that cheap capital getting into the hands of landlords.
Yeah, I think what we saw right out of the chute was while Treasury rates fell, the spreads over Treasuries at which corporate borrowers and real estate borrowers could borrow gapped out, and the weaker the credit, the more the wider the spread gapped out in the bond market, in the mortgage market. That was the first couple of weeks, and then with the government intervention and some of the programs designed to make borrowing cost effective, we saw those spreads widen significantly, particularly for higher quality borrowers. And so, for example, in the bond market, we saw the spreads for triple B bonds narrow considerably, almost back to where they were pre-COVID. Not quite there in the junk bond market. A lot of that having to do with energy and the turmoil in the energy space, and the reality that a lot of bonds in the junk bond market are in fact tied to energy. But with respect to real estate, I think there's a lot of intrigue. Hey, rates should be really low, but I think the availability to get that capital has been muted. And if you think about banks, for example, during the first couple of weeks, they were being inundated with, hey, I want to borrow money. But the first order of business was, I'm being inundated with borrowers who are telling me they can't make their mortgage payment this month because they didn't collect any rent, or they anticipate that they're not going to collect any rent. So I got to deal with those guys. So I think the banks, the insurance companies, I think a lot of the traditional real estate lenders were more than busy dealing with existing mortgages and existing loans, and really weren't open for business when it came to new loans. I think there's a little bit of that now starting to open, but I think if you're a lender at this point, there's no career killer quicker than making a bad loan in this environment. So I think they're going to gravitate to the safest credits, the best properties, the lowest loan to value opportunities, and I think those are the places where we'll see the mortgage financing start to open. And it'll take a bit of time to get there as we move down the quality spectrum, whether it's higher loan to value, lower quality real estate, or some of these property types where the longer term implications of what's going on are much less clear. We've seen a lot of deals that were struck pre-coronavirus that fell out. We've seen buyers walk away on some commercial properties from deposits that were measured in the tens of millions of dollars, their belief being that I'd rather walk away from my $10 million deposit than buy this property and lose a lot more than $10 million right out of the chute. And in some of those cases, the reason the deals didn't happen was the absence of debt financing, or debt financing on very different and less favorable terms than that buyer thought they would get when they struck that deal, say in January or February, expecting to close in April or May.
Yeah, and I think that's certainly true. Where, and I don't know if that comes back to your discipline conversation, because we did see people continuing to move forward, and especially early on in March, where people were still executing at yesterday's prices. And one of the questions that have come through the audience is asking about buying opportunities, and specifically single family. And are we catching a falling, is it time to buy, or are we catching a falling knife? And my personal opinion in the way we're approaching it is, hey, look, we're buyers, and what kind of yields are we looking for, and what kind of deals are we looking at buying? It's hard to tell and put a real number on it. We're buyers of deals that we think are going to be phenomenal deals. And so then the question is, well, what's a phenomenal deal? And I kind of tell people, it's a little bit like porn. It's hard to describe, but you know it when you see it. And so we're buyers just like lenders are lenders, but only the best potential deal that we think we're going to get. And I'm curious, but what we're seeing is, with this little natural kind of a stare down between sellers where, and even stuff we're selling, we're expecting yesterday's prices just like most sellers are, but buyers want a discount. And I'm curious in other asset classes, the feedback and what you're hearing from clients, other REITs and large institution private equity firms. Are they actively hunting, or are they just still kind of on the sidelines right now because nobody wants to catch that falling knife?
If you turn the clock back to February, there was just a mountain of capital looking to get invested in commercial real estate. Tens of billions of dollars that had been committed, but was having a tough time finding a home. That money would show up at the auction of a industrial warehouse portfolio or a New York City office building, and that auction tent would have 40 well-capitalized buyers trying to outbid each other. And so a lot of that money got raised and it didn't get invested. So for the money that didn't get invested, that was probably a good thing, because when it does get invested, it will get invested at a lower price and perhaps a better return. So there's no shortage of capital that wants to buy. The challenge right now is that the gap between what the seller is willing to sell at and what the buyer is willing to pay is gigantic. And the slide you showed earlier, which showed how the public market has repriced real estate, that probably represents what the buyer is willing to pay. But the seller likely isn't willing to sell at those prices unless they have to. And very few sellers have to right now. Now, as rents don't get paid, as mortgages don't get paid, as defaults start to increase, as assets get foreclosed on and lenders sell those properties, we'll start to see the market clear. We'll be able to figure out what prices really are. But in the meantime, unless you have a seller willing to accept a giant discount to what they thought the value of their property was in just February, it's hard to see how things trend. Shortage of capital that is ready to go to buy bargain commercial real estate opportunities. But I think we're months away from that reality happening. I think a lot has to happen before sellers are in a position where they're forced to take prices that buyers are willing to pay to get the returns that they want, given the uncertainty going forward.
And I think that's an interesting comment, because we're so early in it, even though it seems like a lifetime. We're not far enough in it yet where we've had massive loan maturities that haven't been able to either be refinanced or paid off. And it's still too early to see what the true impact of rent forbearance or loan forbearance will have on occupiers and owners of real estate. And in past downturns, the best buying opportunities is always from a distressed seller. And while we've got distressed situations, it's probably just still too early to tell, is it short-term or long-term? Outside of some of those asset classes that were on the far side of the slide, that you go from 90% occupancy to zero, that's hard. That's going to be painful for a while. But the other asset classes, that are more traditional, like ours in SFR or multifamily or industrial, you talk about the data centers, it's actually growing. There's probably not going to be a lot of distress if the income remains in place. The valuations may change, and so you may have some loan resets on some covenants, and so there could be some stress from borrowers on portfolios that their LTV may be out of whack or up against a covenant. But if the income's in place, typically you're not going to have a lender squeeze you too much. At least you wouldn't think so.
Yeah, you mentioned multifamily, you mentioned apartments, multifamily, and that's one sector we haven't talked about. And what was interesting in multifamily is in late March, the consensus view was, wow, a lot of people aren't going to be able to afford rent. Rent collections in apartments is going to be really bad. And in the public market, let's take the apartment REITs down and let's get really worried about apartments. And then what we learned, and you alluded to it before, people that had rental contracts mostly paid their rent, and the collections for April were much higher. But then as we got to May, the concern was, yeah, but the layoffs didn't really start till March, and people still had money in their pocket, and some of them got $1,200 from the government. That's what they used to pay the rent. That's not going to happen in May. It's going to be really bad. And then May came along, and the rent collections in multifamily were actually higher, a couple of percentage points higher in May than they were in April. So, it's interesting to wring your hands and to reach conclusions that seem logical, but then see how behavior makes your conclusions incorrect. So, apartments are a close cousin to your SFR business, and I think it's worth pointing out that a lot of the initial concerns with respect to doom and gloom in the apartment sector didn't come to bear. And people need a place to live, and they're going to pay their rent unless the government says you can't kick them out, which has happened in certain jurisdictions. You cannot evict people. And naturally, in those jurisdictions, the rent collections have been lower than in places where the government didn't say you can't kick people out if they don't pay their rent. So, you got to be mindful of what the government is saying, how different the approaches have been from state to state and within states from county to county. But the good news in apartments is the rent collections have been far higher than I think most people would have guessed just back in the end of March.
And that leads me to a question I'm curious about, and not that you want to make it a political pundit call or an opinion, but I am curious about the opinions that you may be hearing from some of your clients on the place of politics in the current environment, especially where you have moratoriums being put in place where landlords can't evict a tenant even though they've been given stimulus to continue to afford their lifestyle or pay the rent or whatever it may be. It's almost like there's a section of the government that's saying, hey, we're going to give you all this money so you can continue to live, but you don't have to continue to pay all your obligations, yet the landlords are still forced to pay all their obligations. Seems like there's a disconnect there on that side of it. And so I'm curious if you've had discussions yet, or if you've heard anything on a one way or the other, if real estate and the values and the market is going to swing one way or the other, depending upon who wins the White House in November.
Yeah, it's an interesting question, and at Green Street, we talk to the who's who of investors from around the world, and now that you asked the question, I can't remember a conversation I've had with any of them about the presidential election. The absence of debate over who's going to win, who's going to lose, what are the implications. I can't think of a conversation where that came up. By contrast, there are a lot of conversations about states and real estate values in certain states where the exodus of jobs, where concerns about rising taxes had already been in place. And Illinois and Chicago is probably the poster child. If you don't know, Illinois is going to be first when it comes to turning off the lights. They have pension obligations, which are so far underwater that there is no way that the state of Illinois can honor those obligations. And naturally, the strategy has been raise taxes. And as you raise taxes, then more businesses and more high-income earners move out of the state. It becomes a death spiral. Illinois will be the poster child, that will be the case study. And Mitch McConnell has suggested that states should go bankrupt and recast those pension obligations. And I'm not sure legally they can do that, but I think directionally the spirit of what he's saying, which is, people are going to move out until you fix your own problems. You got to fix your problems. Illinois will be the first state where that happens, but the implications for a state like New York are significant. You've already seen high income hedge fund guys move their 15-person operations out of New York to Florida, where they don't pay state income tax. But it's not going to be the 15-person hedge fund. It's going to be significant corporations if the answer to the fiscal deficits is tax people, tax corporations, tax property. I think you run out of options at some point. And California is on that list. The differentiator in California is we have tech, but even there we just have a fragile structure. 2% of California high-income earners pay 50% of the income tax, and a lot of that income tax is dependent on tech-related IPOs and capital gains, and that's not a sustainable model. It's just a very, very volatile model. So to your point on the election, it doesn't even come up on which states are going to really have problems from a fiscal standpoint. Is it priced into real estate today, and the real estate prices reflect the reality that if higher taxes are the only solution, that people will vote with their feet and move their companies to other places. That seems to be something that's top of mind, and what's happened over the last 8 weeks accelerates that in a very significant way.
Yeah, it's interesting, isn't it? I read yesterday, I think Nashville had a new proposal to increase their property taxes 32% to help cover and offset the loss of income and revenue that they're seeing because the city's been shut down, and tourism and things of the like are such huge revenue generators for that community. And when that goes away, the city's looking at ways to make up for it. And to me, that just sounds unachievable to absorb for property owners, residential, commercial alike, if that line item is increasing at that level of rate, and you're being impacted elsewhere on the revenue side. It'll be interesting how this plays out district by district. Hey, listen, we're coming to the end. We had one question also that I wanted to address that came in from the audience, and it's interesting. You mentioned earlier, you made the comment that potentially 50% of the regional malls may potentially go away, and office and low occupancy office could not be easily renovated and converted into higher best use office space. Do you see, or have you yet had discussions with clients about what the value add possibilities could be in these types of assets that are no longer the highest and best use in their current format?
Yeah, and at Green Street, we've done a ton of work over the last 3 or 4 years on the mall sector. What's happened there has been a slow bleed. But when you think about Sears, you think about JCPenney, you think about Macy's closing stores. More recently, Neiman Marcus going into bankruptcy, Lord & Taylor liquidating. The traditional anchor box at a mall has undergone significant transformation, and in high quality locations you've seen some very creative uses. You've seen former Sears stores turned into Targets or Costco's. You've seen them turned into non-retail uses like multifamily or hotels. But there's a limit to that. The prerequisite is you need high quality demographics surrounding that piece of real estate. And you have that if you're in Orange County, California, where we are, Laguna Hills Mall, right in the middle of very, very high demographics, incredible flexibility as to what ultimately happens to that mall, which has been demalled. It's taken a while to get to a decision on what to do, but the demographics surrounding that will make that property extraordinary, whatever use it ultimately is. But if you think about a mall in upstate New York or in the central Ohio, where the demographics and the population growth have been poor and negative for many years, there's not much higher and best use for that property under any scenario. And those are the malls, and you've seen them trade. You've seen million square foot malls trade for $5 million, $5 a foot, a fraction of their original construction costs from 1970 or 1980. The reason being, it's a big piece of dirt encumbered with a building that doesn't have much of an alternative use. So with the malls, it's incredibly dependent on where they're located. What happens to the Sears boxes, the JCPenney boxes, is determined by what the alternative use might be. In higher quality locations, it wouldn't surprise me to see additional medical uses, to see schools in those locations going forward, to see those become government centers so that municipalities can sell their older central government offices and make a productive use out of something that otherwise would have been an eyesore. So I think we'll see a lot of creativity. I think the municipalities will be forced to make decisions faster because they need the tax revenue. They don't want the eyesores. They need the jobs. So if there's a silver lining in any of this, it's municipalities will be forced to make decisions faster now than they historically have because they have to.
Yeah, absolutely. And it's interesting in some of these older properties, you talked about the per square foot. That used to be in analyzing an acquisition that you're going to rehab or do value add. There was safety in, a feeling of safety if you say, well, geez, we're in at below replacement cost. And some of these uses, if you look at Sears or Kmart, some of those buildings, the highest and best use for that property was a Sears. and so it's a negative value when you factor in the cost of tearing it down and things of that nature. So that's going to be an interesting sign of the times. Hey, listen, we're running up on the hour, and for the audience, we'll have this link redistributed for all of those that participated, and we can get you the chart. We've had several people ask if they can get a copy of that chart, and we can redistribute that to you as well. And Jim, I just want to thank you very much for your time and your wisdom and your thoughts as we're going through these very unique times, and we wish you the best and continued success with everything you and the team at Green Street are doing.
Thanks for having me, Jeff.
All right. Take care.